Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and watching our Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. How are you doing, D?
Good morning, Will. How are you? Will, can you hear me?
I'm not hearing you right now. Does everyone hear, D?
You don't see me? I could hear you.
Can anyone hear me?
Will, I could hear you. Can you see my screen? Will? Hello?
All right, we're being heard, D. Everyone can hear us. It must be on my end, so keep going. I brought up your screen.
Okay.
All right, there it goes. It's popping up now.
Good morning, everyone. So we'll talk about quickly just how to read a time and sales ticket for an option trade. I'm going to give you, we'll go over an example and see, what type of insights we can get from time and sales feeds. So I'm going to use a symbol here as an example. Let's go to Google. And then we'll go to the Google's main page. Once we land in the summary page on the left-hand side, we have a menu. We're going to click on options and option chain. I'm going to click on this menu to minimize and expand our screen. And the idea behind a time and sales is to dig deeper into the details of the trading volume on a specific option contract. So when we have volume, we segregate it and analyze it in different ways. Like volume, we could just take the total volume, aggregate it, and then we have this total volume in Google. So let's say it's 225,419 option contracts traded in Google. Well, with option contracts, they're not all the same. Right? There are different, there are calls, there are puts, there are different strikes, different expirations. So even though we aggregated that volume, where did it come from? That's just all option contracts, no matter what type of contracts. So if we wanted to go deeper, we have to keep going down. So the next level is we can go and get a volume by expiration. So on the left-hand side, we see these different expirations available to trade for Google, August 15th, August 22nd, and so forth. Then we have some statistics, and these are the volumes for each expiration. Right, so here's a volume on August 15th expiration, 120,382 contracts. August 22nd, 24,143. So see, we could go down, keep digging down to get an idea, well, where is this volume coming from? Where are traders showing interest, right? So we could see just on the left-hand side, there is much more trading interest in August 15th expiration, which is the closest, most expiration relative to, let's say, if we go out to December 18th, only 675 contracts. So now this gives us an idea which expirations have volume and how much. So let's say we are interested in a particular expiration and we see that there is trading volume and we want to explore more. Well, what's trading in this expiration? Let's say I'm interested in August 29th. My research shows this and this about Google. Either I want to hedge a position, I want to do a buy rate, so I'm interested in this August 29th. But what are traders doing? What type of trades are they doing? Are they trading calls? Are they trading puts? What strikes? So let's click on that, August 29th. It takes us to the next level. Now we're on the options chain for August 29th. And we see the calls on the left-hand side, puts on the left-hand side. I'm sorry, calls on the left-hand side, puts on the right-hand side. We have strikes in between. So this tells us details about each contract in the table, right? There are different calls, there are different puts with different strikes. And you could see here there's a volume associated with each of these options. So for example, Google on this August 29th, the 200 strike call traded 393 contracts. The 200 strike put traded 152. So now we could see the volume distribution within the expiration and what are people doing? What are people are trading more of the 207.5 calls than they are the 200 calls. And the maybe the 195 puts, they're trading more than something like the 160 puts. So now I have an idea where there's trading activity and trading volume. And as a trader, if I'm interested in something and I see volume, then I want to analyze that because that's part of my price discovery. Where should I put my execution? What are traders doing? And so forth. So then now I got this detail. What about what actually traded? So let's say we are in the 200 call and we're interested in this. There are 393 contracts, but I want to know what happened. Was it one trade? Was it many trades? Was it in the morning? Was it in the afternoon? Or was multi-leg trades? Like I want to know in more detail what happened. That information is key. So then we click on here and we get this time in sales ticket, and we have more information to dive deep. So up top, first we have this market data, and this compares yesterday's mark-to-market close to the most recent market. So what we could see then quickly, what would happen to this option value, right? So yesterday it closed $6.95, 705. That was the market. Now it's 855, 865. So now we know on the day, the value of it, besides the trades, just the value of that option increased, which could be contributed to up here. We see the stock price increase 1.3% and implied volatility increase 5.6%. So this option, you can see here's the implied vol 30.9. Now it's 32.6 on a bid. So what we see is that the value of this option was impacted by two things. Increase in the stock price, a call, because a call is a derivative, increase in the stock price, and an increase in the implied volatility. So two factors weighed on the explanation for the change in its value, right? Okay, now we got this information. Let's dig deeper into the trading activity. And here we see each individual trade in a list. This is our time in sales. You can see throughout the day. You can see here the timestamps: 3:54:20, 3:38:59, 3:32:30. So this is based on time. So each trade has a timestamp. So then we could go back and see the sequence of the trading activity, right? From the very morning, 9:30:01, and the sequence of these trades, how they traded throughout the day. Down here, we have a summary of them. There are a total of 123 of these trades, okay, individual trades, for a total volume of 393. And the reason is because you can see some trades, we have 5 contracts, some trades, we have 1 contract, some 7. So the volume is the total number of contracts. The trades are the transactions, the number of times there's a transaction. This is the notional value of all the trades, 327,162. And what this is taking the volume times the price paid for the option and getting the total dollar value of the trade. So the dollar of the value of the trade could change because you could have a different quantity and different prices. So here you have 5 contracts that traded for $908. Well, that trade involved $4,540. This trade involves $6,293. And this lets us sort if we're looking for maybe higher dollar value trades and see what happened. This is the open interest. And then we do have a summary of the volume weighted average price. So if we take the price of the trade multiplied by the quantity, sum them up and divided by the total volume, we see the volume weighted average price. This is instead of the average price that we weighted by volume, where did essentially, the bulk of the trades happen. This is the highest price, this is the lowest price, and this is the last price. So last traded 872. The lowest price, the highest price from the day was 918. The lowest was 695. So we have the dollar range, the volume weighted average price, and the last price. And then we do the same thing for the implied volatility. Okay, so this is similar. Look, the VWAP volatility, the high volatility, low, and last, which lets us quickly assess the range of the implied volatility from that traded from the high and the low, the weighted average implied volatility, and the last. So now we got all these details helping us with the price discovery, because now we have an idea where people were trading it relative to prices, relative to implied volatilities, ranges, and then here are the full details where now we have timestamp, quantity, price, dollar value. So this is adding to, this is adding details to the trade. The time, at the time of the trade, what was the market, the bid and the ask? So then we could kind of compare where the trade transacted relative to the displayed bid and ask to see if there was a order, did the trade get executed on one of the displayed markets, or was there some price improvement where it traded in between? And this gives us a good sense of, well, how can we place our orders? Like if we see that, hey, when the markets are 10 cents wide, I see prices trading at the midpoint, right? So like something like here. When the prices are 5 cents wide, I see them trading, on the bid and the offer. So, something like here. So this gives me an idea, well, how should I try to place my orders, place my prices relative to the displayed bids and offers, and what are my chances of getting a better quality execution, right? And here we could see that many of these got traded in between the bid and offer, which shows us, hey, there's liquidity there that could be hidden, that's willing to trade in between, better than the displayed bids and offers, right? So this is telling us the price, that there is liquidity and an opportunity to get better prices. These are the implied volatility of the trade. This is the hedge or reference price. So this is where, if you're hedging option trades, you're looking at the price of the stock, where it was. So that's where the price of the stock was at the time of the trade. And this is important because we see, well, this traded $9.08 and the stock was 204.82. This trades at 872 with the stock at 204.34. So we could see that, where the stock's moving around, the options moving around, and we have those two references to compare. This tells us the exchange, because there's different exchanges that you could trade. Google, you could go to Civo, Amex, BATS, MIAX. And this helps us also assess the liquidity potential by exchange, or we may want to direct it based on what we're seeing. So if we're seeing a lot of trading going on in CBOT, a lot of improvements, maybe we want to try to direct that trade to there. If we're seeing something happening a lot on one side of the market and we're trying to get on that side, and it's being directed to a certain exchange, we might want to direct our order to that place. So you could see that the exchange is where things are trading, what prices, what type of liquidity may help you make a decision if you want to try to direct your order yourself to a particular exchange to try to get a better quality execution or a higher chance of getting executed. This here tells us the condition, which says, okay, options can trade differently. Some of them could be part of a multi-leg trade, which means this option in particular was involved in a multi-leg trade, which could then be part of a different, there's another leg tied to it. Could be 1 leg, 2 legs, 3 legs, but this involved a trade that was entered in as a complex order multi-leg and executed as a complex order multi-leg. So this distinguishes from just a single leg trade like a regular trade or an auto execution, where this order just came in as, a buy or sell of this call and got executed, buy or sell of this call. So now we went from the high level and kept drilling down to essentially get the details to help us now make better, more informed decisions based on the data available. So what I'm going to throw back to you, that was the time and sales.
Yeah, it was a great webinar, Dee. Brought a lot of information about options, time, and sales to the Chameleon community. Thanks again for all these great webinars. For those who missed yesterday's IBKR webinar, you can go to their website and register for it still today. And if you want to see it in replay, it will always sit on the IBKR, that's Interactive Brokers library. That was a great show yesterday as well, Dee. Thanks for doing this, my friend.
Thanks everyone for joining. Stay safe out there. Have a great trading day. And we hope to see you guys tomorrow.
We'll see you tomorrow. And tomorrow will be our last show of the week. On Friday, I have to take one of my kids to college. I will not be available on Friday, D, just FYI. So
yeah, same here, actually. I think in Monday and Tuesday for me. I'm heading up.
All right, so we'll have a series of days off, but I will put videos out there each day for everyone to see. And great job, D. We will see you tomorrow, the last show of the week. All right. Bye.
Thanks, Will. Bye.
All right, everyone. Thank you for joining us. Thanks for the information on Ann Arbor, Rob. Much appreciated. I will be there on Friday. Everyone, you have a great, safe trading day. Remember to like and follow on all the social platforms. If you're on YouTube, thumbs up, always appreciated. And click the follow button. Everyone have a great day. Thanks so much.